Investors and analysts often use the EBITDA multiple to quickly estimate what a business might be worth. Let us break down what that really means. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is a way to look at a company's core operating profitability. By dividing the enterprise value by the EBITDA, you get a multiple that shows how many years of earnings it would take to buy the firm. Multiples help investors compare companies of different sizes or tax structures by stripping away non-operating expenses. While P/E ratios are popular for stock picking, the EBITDA multiple is preferred when looking at the whole business value, including debt. Different industries carry different multiples based on growth expectations and risk. Tech companies often see higher multiples than stable manufacturing firms. Remember that multiples are just tools. They do not account for future growth or specific operational risks unique to an individual company. Understanding these metrics helps you analyze investments more clearly. If you found this helpful, check out our other videos on financial basics.